Um, but what portfolio management structure are you using? Do you even know the differences between the portfolio management structures? For example, are you using the Jones model, which is the classic fund structure? So the Jones model, you run in the old days, pre-08, 150 long, 100 short, 50 net, right? And then you manage to diversify within industry, market cap, geography, and investment style, right? Within your longs and shorts, and you try to stay net long the way that Maverick does it. If you haven't read Maverick's Harvard Business School business case where he describes this, it's a must read. Lee Ainsley likes to run positive net exposure within every sector. Some guys will let run a negative net exposure within sectors. I happen to love the Jones model, right? I think the Jones model is one of the best gifts you can have to investing. Except today we run a modified Jones because you have to run modified post '08. The market structure post 2008 has changed. And I believe that running, and I could be wrong, but not to invite too much debate over this with the investment dorks that are out there. I am one of those guys, by the way. I'm an investment nerd and a dork. I believe that running to 50 is too high gross today. With the way that stocks move, with the way that narratives build, with the new market participants that are entering, with the way that algorithmic trading happens, I prefer to run 190, right? 120 long, 70 short, 50 net with about a 2.7 long short ratio. But do you want to run factor neutral? Do you want to run beta neutral? Do you want to run a long only concentrated? Do you want to run? But whatever you do, know the idiosyncrasies of the structure that you use. You're the captain. Your fund structure is the boat that you're going to use to navigate the seas that are out there. Pick the right fucking boat. Okay? Other problem. One realization that we had, and it took us a while to have it, and other friends of mine warned me about it, is that fund structures have to do with personality. We used to run 80-60 until a dear friend of mine, one of the best PMs in the world, told me, hey, you're not an 80-60 guy. Why are you running 80-60? You should be running, higher gross exposure and a little bit more diversified. And as soon as we did that, our returns shot up, even at the time when the market was actually declining. And it's very important to read about these fund structures and to study them. There is such a thing as portfolio management alpha, right? You can add a lot of value with the way that you manage a portfolio, just isolated from stock picking. And remember this: there's three forms of leverage: gross exposure, concentration, and beta. Run max on only two of these. If you're high gross exposure, high beta, you better lower your concentration. If you're high concentration, high beta, you better lower your gross exposure. Okay? The guys that I know that run at all three of these, they might succeed, they might succeed for a short time, but then you hit a drawdown, holy shit. Okay? It can be very painful.